The way I got involved with investing was not directly. So I graduated college. I had an undergraduate degree in accounting and got a master's degree at night in accounting. So I worked for a public accounting firm in New York and did audits. But I was fortunate because a lot of the audits we did were actually of investment advisory firms, and a number of them extremely successful and well-known firms. The most important probably was Tweedy Brown. So Tweedy Brown was historically next door neighbors to Graham Newman, Graham being Ben Graham, and therefore having a long lineage of at the inception of value investing. And one of the founders of Tweedy Brown was Tweedy Brown and Riley. Joe Riley became my mentor in the business. So seeing what Tweedy bought and sold, what they owned, at the time it was a small place, to talk to the entire trading desk and the manager of the firm. Walter Schloss was in the office, so Walter's a longtime confidant of Warren Buffett. So it was great pedigree, and therefore didn't have classic finance learning in school. Instead, I learned how to pick stocks that were value stocks that made sense. The other audit client was Mario Gabelli. So of course, Mario Gabelli's been a very successful investor and manages over $40 billion today. And that's when I worked for Mario. Every day he'd go through his favorite idea. So that's what I say. I had an executive MBA program taught by Mario Gabelli, one-on-one, and he paid me to attend class. I didn't pay him to attend the class. So my personality is kind of cooperative and friendly, and probably in certain ways not discerning enough. I probably should be harder, and that probably would be helpful, some of the investments that I have. But I think there's a trade-off in life, and I think the firm that I have created over the years, a lot of it has to do with the personality I do have, and it is a very cooperative, congenial place. And so not only have I been there, but there have been 5 other investment firms that have been extremely successful that initially were kind of formed and incubated kind of in our firm. And so I gave those people the freedom to do what they wanted and think about value investing in their own way. And that's what I do think value investing is. It's not a hard definition. There are many different ways to apply the concepts of looking for margin of safety and therefore getting great returns over time and therefore being concerned about risk in that process. So there's more than one ways to go through that, and in that collaborative process that I think that my firm has, it's good for them and also great for me in terms of seeing other people's views on what is great investing. So initially, since Tweedy did a lot of by the numbers, Graham kind of a cheap, less than book, less than net working capital kind of investing. That's what I did. I was an accountant. I could calculate book value. I could calculate net working capital. So I bought cheap stocks. And over time, what I find out is that cheap stocks frequently are cheap for a reason. It's cheap based on asset values, and those asset values aren't indicative of what the future cash flows of the business are. So every business is worth the discounted present value of those future cash flows, and historical accounting numbers probably don't give a great indication. So what we did do was look back and say, well, which investments made sense and worked out for us and which ones didn't? And there are 2 categories. One of them is companies that were run by managers and or owners who understood capital allocation, and therefore even if the assets were cheap, they then diversified and bought new assets that therefore got returns, and or it was a business that was cyclical and it was cyclically depressed, and the earnings power of the business was significantly greater than what the business was trading for at the time of our entry price. I guess I'm probably, I will invest in companies that have a reasonable amount of debt associated with it. And I think, and I do think that's like one deviation, and it's always bad to deviate from anything that Warren Buffett says, because, he is such a phenomenal investor. But one of, his axioms that everybody knows is the first rule of investing is don't lose money, and the second rule is don't forget the first rule. We will invest in companies that do have leverage and are in difficult situations in cyclical businesses that provide, we think, an entry point to buy the business at a fraction of what the business is worth, understanding that the complications of the business environment and the balance sheet may give issues, but we think about that in terms of, okay, so is that a solvency issue? Is it a dilution issue? And what do we do? And can we continue to invest even if things kind of go poorly? Because I guess another axiom out there in the investing world is, right, the famous Rothschild, comment is that invest when there's blood in the streets, including sometimes when that blood is your own too. So by being persistent, that even if it isn't working for you, if the concept really makes sense and there's really probably a great opportunity, it probably gets greater when it gets dimmer. And so therefore that includes some risk in that process. And if you can make 5, 10 times your money, it's obviously willing to take those risks for a couple of those being things that don't work out, especially if you're always constant to what's the same opportunity, another opportunity in the same opportunity set industry. So they refresh themselves and give you the opportunity to play again. Nope, we don't hedge anything. Don't hedge. We invest overseas. We don't hedge currencies. Too much time and effort to try to figure that out. And hedging currencies or hedging things frequently has to do with the volatility. And we don't think that volatility is an assessment of risk. And then it takes effort to do that, and then potentially takes you down a road that you don't want to go down. I think it's just one of the risks of the business and the environment that the company's in terms of, okay, so what can go wrong? How can that go wrong? And you can't necessarily know how it's going to play out. So being cognizant of that and being attuned to that is really the kind of the best you can, and continuing always to be alert to new risks that come up or risks that have been there that become more significant, and how that kind of may enter into the equation as price to value, and therefore what the ability of that company to be a survivor and therefore participate in the eventual recovery. That's an important component. It's relatively low turnover. So there are years where it's probably single digit even. So we do tend to be in things for longer periods of time, and I probably don't sell things quick enough in certain times, but I often find by staying with it. What I also find though is I've gotten more persistent in staying with investments that really have worked out. Because that's what it is right? If you have a few investments that you're really right on, and if you sell those and take a profit, there's no risk in taking a profit. That axiom, that's a bad axiom, I do think. Then you've cut off, and I do, in one of the speeches I gave, is that the biggest loss I ever have was exactly that, having a great company and having been consistent and stayed with it as it traded down, bought more of it as it traded up, but then started to sell too soon. We're cognizant of it. We clearly, there are investments we have greater conviction on. The idea that we would own more of it is totally consistent with us. Given even if there's some volatility that kind of comes from that. That said, and we're also, since I'm also saying that if I find an investment that really works out well over time, to not sell too soon is an important component, because I do think there's a multi-year recovery. And so that means in the past we've had investments that were 6%, 7% of the portfolio that grew to be very large percentages of the portfolio. And so staying consistent to an idea that is in the process of really working out well and has great room for improvement. I don't want to be constrained by a portfolio constriction rule and therefore selling something down like that. Yeah, it's as much a judgmental question as it isn't necessarily a calculation in terms of value, because it really it's predicated on something could even trade at more than what it's worth, and to sell it would be premature, because more than what it's worth is still a transitory kind of measure. And if the business is in the right position and the company's done the right thing and the management's the right position and they've got a demonstrated record of continuing to build value, so that's part of that equation, as opposed to in other situations, it may trade for 70% of what it's worth, but given the facts and circumstances of the business and the people, you may determine 70% is full value, so let me move on. And part of that is also predicated on capital inflows and outflows, so therefore we tend not to have inflows, and so therefore since there's no inflows, there's no source of new capital, and so that tends to mean we probably own things a little bit longer and own them at even longer periods of time. Cash is just an outcropping of the portfolio. There have been times where we've had 20% or more in cash, and it was just the opportunity set that we understood that we thought was in front of us was such that we couldn't find things to buy, and so therefore we won't buy it. Conversely, if we think the market may be fully valued or concerns and all of those things, but yet we find things that we think are individually compelling, we're going to own the securities based on the individual assessment of the investment and not on a portfolio construction mandatory cash balance, minimum, maximum. So multiple ways. So the firm itself has 8 people who do research, so therefore everyone has a little bit their own niche and their own approach to things. Some of them do pretty heavy screening. We constantly look at things that are out of favor. That said, myself and 1 or 2 other people in the office have been doing this for 35 years, so we know a lot of names, and so therefore certain names kind of rotate back in certain industries. So, we do look at, of course, things like spinoffs and companies doing buybacks, and they're doing a buyback with the right construction, that is there's insider ownership and the insiders aren't selling, then that gives indications that somebody knows something who's pretty smart and has accumulated capital. And so what do they see that potentially the market doesn't see? So the problem is there are too many new ideas to continue to look at. It isn't how do you find an idea? Even in the current world, we think that the opportunity slate of individual companies is extremely large, and we don't have a tough time deploying the capital that we have. Gaining any piece of information is relevant, and every piece of information potentially can lead you to a wrong conclusion. So therefore, the conversations that you have to be taken with every other piece of information. And is it right? Is it wrong? What's the biased position of the person who's telling me this? So that said, it's better to have more information, even if it becomes problematic. And how do you assess that? Because every investment's a mosaic, and every piece of information you have, there's an extra piece to the mosaic that you could potentially put together. And there's misinformation from one person may be the key to really understanding the investment opportunity. So the more you can get, the more you can talk to people who may have biased points of view, but have relevant information is really important in an investment equation. Gee, I don't, if I had to guess at one, and I don't think there really is one, but in many ways, revenues is really something, because if you don't have revenues, you can't have profits. And if you have revenues, the idea of figuring out how to get the equation right so that therefore some of that and more of it starts to convert into profitability gives some inherent sense of what the possibilities are for the business, and may give indication that there's a business that's significantly undervalued and mispriced. You're constantly aware of it, and you constantly know you're going to make mistakes. So that's part of the understanding of it. And so therefore, in certain situations, you do need to sell and to move on. And other situations, you have to continue to look at it, because, of course, one of the things that's happened is the price probably is performing poorly, and so the valuation is changing. So therefore, that's part of the equation. It's always price to value. And so fundamentally, one of the things kind of moves to your advantage. And is that valuation move maybe more significant than where you were wrong in terms of some assessment of the business, and were you wrong from a fundamentally long-term point of view, or were you wrong on timing and when something would happen? So those are two different errors in judgment, because one of them will rectify and the other one won't rectify. Well, there's plenty of sectors to avoid, and so for me, it's mainly technology, and that's basically, it's not a core competency. So for somebody else, it's the place to focus in on because they know the business. So a lot of it, and probably the place for me to focus most on are two places, and that is energy and that is home building in America. And those are two places where we think we have significant amount of years of experience in judgment and understanding of those businesses and how volatile they are. And that's really important in terms of investor understanding of the business and potentially misunderstanding the business, and therefore understanding value opportunities. And of course, we have capability to do that better than we think other investors. And that's almost across the board, because almost anybody else who's an investor in those space has probably not as long a timeline on it, and so therefore have a different perspective, and probably not as rich as we would say the perspective we have. Sure, Subsea 7. I spoke about it last year at last year's conference, and it's a company that we've known for a long time and have valuations great. The opportunity of the business is improving, insider ownership, great capital allocation, strong balance sheet. So it's got a litany of things that make it an excellent investment today. Yeah, I'm not a big book reader. I'm an annual report 10K reader. So I'm reading kind of like live things as they develop with everyone's opinion on things, because it's still opinion and people express. But I find that kind of more enjoyable, more interesting, and more pertinent to the investment process.